Welcome to Founder Files, the podcast for growth-minded leaders, investors, and operators shaping the future of business. Each episode dives into the critical decisions behind scaling, from finance and fundraising to leadership, strategy, and technology. Founder Files is powered by Cypher, the AI-powered and human-led finance partner helping growing companies scale with clarity and confidence. Learn more at cypherfin.com. Gonna make a quick intro of Bayaan. Bayaan you're a CPA, you're the founder of KTB Services, you're a partner of Cypher, we work on a few clients together, and you're a PwC alum, just like me. That's super cool. Thanks, Bayaan, for being here.
Thanks for having me, Salma, and it's been exciting to partner with you for a lot of our mutual clients, and happy to be on here.
Well, Bayaan, I've done a few of these episodes, and I especially excited about this one for, a very simple reason. Taxes are a headache, and they're a headache to so many people. So we get so many questions on taxes compliance that I end up deferring to you. And I'm just super excited for you to be here today because I really, really love the way you explain everything. It's so clear. I'm sure a lot of our listeners today are going to have so many light bulb moments just because of how clear you explain things, no jargon, no technical terms, just very easy, straightforward answers.
Yeah, no, definitely. And I get it a lot from working at Big Four and also other big firms in my career, right? If you can dumb something down or say it in layman's terms, I think it goes a long way with communication. And then clients see the value of that, right? Versus
Exactly.
all the tax jargon that we have to deal with.
And they're less scared to ask questions.
Exactly.
So we do get a lot of questions, and that's how I want to structure today's episode. Really just ask you all of the not all of them, because we won't get to do everything, but most of the FAQs that we get, ask them to you and then have you answer them so that people get enough clarity before year end. And with the new year coming up, I'm sure there's a lot of
For sure.
questions that they have in mind. One of the first ones that I usually get really often is related to entity structure. I feel like it's like an identity crisis when you ask someone, hey, what type of company do you have, or how are you taxed? I usually get answers like, well, I'm an LLC and I'm taxed as an LLC. Well, first question is, can you clarify why that's not a good enough answer? And second question, maybe I'll ask you right away, how can a founder understand and choose the right tax structure for their LLC?
Yeah, no, I would say that's probably one of the most popular questions and one of the most important questions, especially in this age of there are a lot of startups popping up and scaling quickly. An LLC is a legal term, right? So it's a limited liability company. Too many times it's the easiest and default setting to create a company. But I'm going to give you a real CPA answer of it depends, right? Like, which is what we tell all our clients. But it truly depends. What you want for that company, the vision you see, these are all questions that should be asked at the ground floor, ground zero, because then that helps whoever your advisor is give you better advice. And I always say a CPA is not enough, right? You need an attorney, you need a CFO, and you need all of that kind of to get all the lay of the land and to see what the vision is of the company. Because that in turn will give advice of, hey, this is what we think you should be. So for example, in an LLC for a startup who wants to raise funding, most likely if you want to use venture funding, it doesn't work, right? Venture funds or PE, they typically want a C-Corp, which as an LLC you can convert to a C-Corp. But why create that extra paperwork if I already know the vision of the company and what you want to do in the next 3 to 5, 10 years, even though you might not see past 1 or 2 years just to get it going.
But at least have some clear goals in mind. And it's good
Correct.
to have a finance team, including the attorney, the CPA, the CFO, that ask you
So
those
important.
questions. So, well, then let's talk about C Corps first, because obviously a lot of CEO founders are structured or a lot of startups are structured as C Corps because they're going to raise from VCs, etc. What are some top 3 tax strategies that they should be thinking about from day one?
Super important. We're in the age of software, or we're past the age of software. Now we're in the age of AI, as most people would argue. But as a C Corp, if the goal is, I believe everyone's goal obviously is if they can go public, they go public, which is IPO, initial public offering, or get bought out by a bigger company and ride off into the sunset, right? But the reality is majority of them don't get there. However, if you want to put your best foot forward, increase the probability as a C Corp, you also want to make sure you're maximizing your tax strategies as you're getting there, because the biggest thing with founders and startups is do we have enough cash, and how much taxes are we paying, unfortunately.
Exactly.
So I would say setting up the C Corp right and ensuring that you have all the tax optimization available to you is super important. This is where you want to loop in your tax advisor. So one of the biggest things with C Corps is the QSBS, which is Qualified Small Business Stock.
Yeah.
That's super important for C Corps who are startups and do want to eventually raise funds, exit, get bought out, and all that. And the reason why is if they are lucky to get to that stage where they get bought out, and believe it or not, it happens more often than not. I would say the number is just not where people want to be. But regardless, the QSBS, and I'll just keep it super high level, I'll oversimplify it. It allows founders of stock that they created or a corp that they created to exclude up to $10 million in capital gain, which is huge, right? So we've had founders who, when they had an exit event, which they didn't even see coming because they're always trying to get to the next level, they essentially, depending on your tax structure and depending on your planning ahead of time, they paid zero tax, right? So those are like, I would say the Cinderella stories, but it could happen a lot more with nowadays where if you scale super fast, somebody want to buy it out for millions of dollars, and all of a sudden now you've done the planning from the ground up, and you could ride off into the sunset.
Oh, yeah. So planning, super important.
100%.
It's super chaotic. You got to have that team that helps you plan. What's a common tax pitfall that startup founders overlook until it's too late? I guess this is one of them that you just touched on. But what are some other ones? I mean, the ones that I see, maybe they're not related to corporate taxes, but for example, R&D claims, taxes, those are things that are not really thought of. What other things can you think about that, they miss as they think about their compliance?
Yeah. I'll start with R&D and I'll go over to sales tax because sales tax is a lot more heavy, but so R&D, research and development, with startups, or I should say with any business, if you have some sort of research and development, the IRS allows you to take a credit, and that credit can reduce your tax liability. So this is huge savings right off the bat. However, just like anything in tax, nothing comes easy. You want to make sure you have the right team and right professionals looking to see if you qualify for the research and development credit. But essentially, at the end of the day, if you do qualify, it's taxes that you can reduce your taxes by that R&D credit. Now, of course, there's a lot of complexities how to get there, but that's where your team and that's where the expert comes in. Now, the issue with corps that do qualify for R&D or entities that do qualify for R&D, the Tax Cuts and Jobs Act of 2017, it implemented something with the research and experimentation. I won't even get into the details, but it's called 174, which has always existed, but now it required corps or entities that have R&D to add it back, which was a huge pitfall for a lot of entities, because then now it created almost phantom income. So this is where, some people do their own R&D study and say, oh yeah, I have 30% of R&D, but yeah, that could work, but that's super, super high level. And then with this 174, what it did, it added back a lot of expenses that you thought were expense. And now you have taxable income. So this was a huge surprise with the new tax law that happened over this summer, later in the summer, the OBB, One Beautiful Big Bill. It helped a little bit with the 174 capitalization, but there's still the pitfalls. So I think the message here is more of you really want to invest in a good professional, a tax team, a finance team, because they would help and they work cohesively to get you to the right answer and to make sure you're taking advantage of what's available to you and not falling into a pitfall. Because the biggest thing with a lot of this is when you do go through due diligence to raise funds, they look at this heavily, and this could make them run away.
Wow.
Yeah.
I totally agree. And you need to be prepared for it ahead of time too, because it also matters that you categorize. It's so simple, but categorizing things properly will save you so much time when you're ready to do the R&D claim. And
100%. 100%. Yeah.
So what about sales taxes? The big
right. The sales tax landscape is so broad, and it gets super specific. Again, I think I'm going to sound like a broken record, but to reiterate the point, the team matters. The experts you reach out to, the experts you invest in, because it is an investment, right? Because it could save you on the back end. With sales tax, a lot of companies, whether you sell products or you provide services or you sell software, now every state is different. So imagine we have all these states in America and you're like, oh, it should be the same. No, it's not. Because some states, they charge sales tax on a minimum amount of transactions, regardless of if you have somebody there. They charge on revenue, even if you don't step foot in that state. So it's become very, very complex, but it's something that is super user friendly to onboard from the beginning. But a lot of founders don't want to do that because they're like, oh, it costs too much. We'll cross that bridge when we get there. But I'm telling you, this has been the biggest pitfall with due diligence where I've seen deals fall apart because of sales tax. So not to
Absolutely.
sound to fear monger, but it's just, this is the reality where the potential buyer or the potential financier, they don't want that liability. And they're like, you know what, this is too much. Or sometimes they will dock the founder on potentially the exit based on that. And sometimes it's a big number, right?
Yeah. And before even you get to that, the nexus studies can get so expensive when you have so many transactions. So why not just do
Yes.
it right from the beginning when you are paying less those experts to figure it out, and then you're starting on the right foot, you're doing your state registrations, filing properly, and then growing from there.
You hit the nail on the head. The nexus study is super important. And to your point, it's very, very pricey at the back end.
The back.
So why not from the start, where it's the cheapest, invest that time and the resources into doing it, and then it's just adding more and more. And I also say it's also education too. So I make it a point to educate my clients because the more they're educated, the more they value everybody around them and they feel more inclusive of the team. Because the worst thing I feel like as a founder, you don't know what's going on and you're like, figure it out. And it kind of devalues kind of the relationship and the services that are being provided to them.
Yeah,
So
totally agree. So we talked a lot about startup founders now, the
mhm.
ones that want to raise capital from VC, eventually IPO, exit, etc. There are some CEOs that have great companies, SMB CEOs, who also want to grow, who are super ambitious, but are not necessarily looking to raise capital. And so they're an LLC and they're asking questions about what they should be. So a lot of times we've seen our CEOs get advice to elect an S-Corp. So can you tell us more about what an S-Corp is, and why would you encourage an LLC owner to elect S-Corp status as they grow?
No, great question. So with SMBs, I always say that, especially when I have a new client, I say, are you a lifestyle company or are you trying to go through the alphabet soup and then raise and potentially go IPO, right?
The
But there are a
goldfish.
lot of lifestyle companies. That's the reality that SMBs that do very well, and they could have been something for a very long time. Doesn't mean it was the most efficient. Again, I'm going to give you the it depends answer, but this is where that analysis comes in. An S Corp is a tax election. It's not a legal election. So as an LLC, limited liability company, you can be a partnership, which means more than one person owns the LLC. You can elect to be a C Corp, which means now you pay your own taxes. It's taxed at the C Corp level. Any distributions is taxed at dividend rates, so it's double taxed, as they say. And or you can be an S Corp. So an S Corp, you make an election, and the IRS treats you as a small business corporation. So the biggest difference between a small business corporation versus a regular C Corp is an S Corp has one level of tax. And what I mean by that is whatever happens on your entity, it's as if the owners or the shareholders of that S Corp, it happened to them. So that's that concept of one level of taxation.
Yeah.
So that's why it's so favorable because you're not dealing with that double tax. I'd say that's probably the most popular difference. As an LLC, now switching over to an S Corp, there are requirements. But I always urge it is worth it, whether there's a lot of software that does it. There's a lot of AI that can give you a ballpark, but ultimately go to your advisor. They can do this calc where they compare an LLC taxed as a partnership, LLC taxed as a sole proprietor versus an S Corp. And it's very important because there's a lot of information out there in social media of, oh, file and create an S Corp, do an S Corp, you'll save so much more in taxes. But I always like to compare apples to apples. If you were in a scenario as an LLC doing XYZ, here's how it would look like if you were an S Corp. And then I also layer in what the cost to file as an S Corp and the requirements to be an S Corp, and then you can have the real comparison. And I think that gives a better flavor to the client to make a better decision versus S Corp, you'll be good, let's go. Right.
I love that.
Yeah.
I love that because that's what it usually is. You know, I'm an LLC, I'm a solo owner, lesbian S Corp, but
Yeah.
there's so much more to it. And again, that was really valuable. Is there an income level that makes switching from an LLC to an S Corp make sense?
There's a range, right? But I would say and I'll start by saying that another difference between the LLC and S Corp. If you're an LLC as a sole proprietor and you make $100,000, the $100,000 you're taxed on the entire amount. You're paying income tax, which is at the rates, and you're also paying self-employment taxes. I would say that's the clear difference from day one. As an S-Corp, that $100,000 of profit, the IRS requires that S-Corp to pay its shareholder as an employee. So that becomes the biggest difference. As an employee, you could pay yourself a certain wage, and that's where you see that difference where you're taxed on the entire amount as self-employment taxes versus you might pay yourself $50K out of that $100K. So I would say at that range, I've seen some savings. But one thing to note, at some point when you're past your Social Security waste page, and I know I'm getting super technical, but I think it's 170 grand for 2025, and they increase it based on inflation every year. After that, you're only taxed at the Medicare, which is 2.9%. Yep. So this is why it truly matters of doing that comparison, because I've seen instances where the 150K, depending on the optics, let's say profit to profit, where an S-Corp didn't make that much sense versus where I've seen at less than $100,000 where an S-Corp did make sense. Because how much are you paying yourself? What is going to be your profitability? What are you doing at the S-Corp level? Do you qualify for different deductions? Because as a sole proprietor, and I know I'm switching back and forth, but it's super important to consider these things. As a sole proprietor, there's something called the pass-through deduction, which you only qualify at certain limitations, right? Versus as an S-Corp, it could supercharge that depending if you qualify. So I want to keep it high level and bird's eye view that there's so many nuances that clear cut, if you switch to an S-Corp, you will save $15,000. That is not always the case. It truly matters of what's your story, what are the assumptions, and then you could get a better answer.
I really wanted to touch on these things because, again, year end is coming up. Tax filings are going to start to be a hot topic. So it's important to understand these categories and these structures and be able to ask the right questions and let
100%.
deal with that. Talking about tax filings, 2026 is about the corner. I cannot believe it. But
already.
What should founders and CEOs get ready to prepare for the year end and going into the new year and also for filing taxes?
Super important. Right now, I would say we're late. However, the advisor in me and the forward thinker in me say, hey, there's always something you can do, right? Now, your options are limited, but there's always something you can do. What founders, business owners, owners of companies, or even if you're a shareholder and you own a piece of the company, at this point, you should be meeting with your CPA or your tax advisor. They could be one and the same, where you're going over projections. Now, you should have been doing projections throughout the year, and this should really just be last touches, final touches. But the reality is a lot of business owners, we're running 100 miles an hour, and now we're like waking up, we're like, oh, it's year end, what can I do? So what I would say is a projection is super important at this time. Very, very important this time. And why? Because now you take everything that we think is going to look like, they should have it, and you determine what your tax liability, your tax exposure. That's when the conversation begins. Because at that tax exposure, we can't change majority of what's happened from January all the way through now. But what we can do is accelerate things and what are the tax optimizations available to you. Whether, you want to prepay expenses, are you allowed to do that? Whether you qualify for, like we spoke about, the R&D credit. Whether there's opportunities to take advantage of now, bonus depreciation is back, which is huge, right? Because it allows you to take 100% of a cost even if you didn't outlay the whole cash. And for businesses, that's huge because they might need equipment, right? They don't really have too much cash flow. They want to preserve cash flow. And now the IRS allows you, if you place it in service, allows you to take the full amount, which that could reduce your potential taxable income. So these are the last minute items where you could think about and say, hey, do we need to run out and go purchase some equipment that could help the business? But I always say, do not let the tax tail lead the dog, because at the end of the day, don't go out spending money just to save taxes that is not needed for the business, because your CFO, your bookkeeping team will be upset because now your cash flow or you're putting yourself at a disadvantage from an economic standpoint, which is way more important if you're trying to, run a business.
It has to be balanced. And it's also a good opportunity, I guess, to plan for the next year, because your
100%.
advisor will start to see how to plan for the following year. And then you're ahead of the game at that point.